If you're struggling with debt right now, you're not alone. Canadians are carrying record levels of household debt, and it's getting harder to keep up. According to recent reports, the average Canadian now owes over $21,000 in non-mortgage debt, and nearly half of Canadians say they're living paycheck to paycheck. So if you're feeling stuck with high interest credit cards, personal loans, or lines of credit, this video is for you. Today, we are going to look at a few different strategies that Canadians can use to pay off debt, and then I'm going to show you live in this video how a refinance can be used to consolidate that debt and actually lower your monthly payments. Let's start with a few of the most common ways that people try to tackle debt. Option one, the snowball or avalanche method. You pick one debt, usually the smallest balance or highest interest rate, and throw everything you can at it until it's gone. Then you move on to the next one. This strategy works well if you've got manageable balances and consistent income, but it does take discipline and time. Option two, consumer proposal or bankruptcy. These can eliminate a large portion of your debt, but they come with very serious long-term consequences. Your credit can be affected for years, and you'll have a much harder time qualifying for a mortgage or vehicle loan afterward. Option three, a mortgage refinance or debt consolidation. This is where things can really change. Instead of juggling multiple debts at 19%, 25%, or even higher, you take the equity that you've built up in your home, refinance your mortgage at a much lower rate, and use that money to pay off the high interest debt completely. Here's how it works in Canada. Let's say your home is worth $500,000 and your current mortgage is $350,000. If your lender allows you to refinance up to 80% of your home's value, that gives you access up to $400,000 total. That means you could pull out $50,000 in equity and use it to pay off your credit cards, car loans, or personal lines of credit all in one move. The new mortgage balance becomes $400,000, but your high interest debts are now gone. And because your mortgage interest rate is likely around 4 to 5%, the monthly cost of carrying that same $50,000 is drastically lower than if we were to put it on a credit card at 20%. And in many cases, the overall monthly payment can drop by hundreds or even thousands of dollars, freeing up cash flow and reducing financial stress. Let's do a quick review of a real-life client scenario of how this could work for you. All right, so here's a live client scenario that I did for a client who had some debt and was looking for some also payment relief. They were coming up to renewal and they had a super low interest rate that they got back in 2020, and now they were also going to face some payment shock, as well as they'd also accumulated some debt. So I came up with a plan that would help them with that payment shock as well as clear off these debts. So to set the stage here, their current budget was this. They had an amortization at 20 years. Their current lender was offering them 3.99%. We estimated the home's value to be worth $500,000, and they had a mortgage of $282,000, meaning they had $218,000 of equity in the property. Based on this information, the client had a monthly payment projected to increase to $1,702. Unfortunately for these clients, over the last couple of years, they had accumulated a lot of consumer debt, MasterCard, line of credit, Visa, car loan, all totaling just under $70,000, $69,000. Factoring in a repayment on these of 3%, it came out to a monthly cost of $2,070. So if we take their new monthly payment of $1,702 plus the servicing of all of this credit debt, we have a total household payment of $3,072.51, and this is crushing them. And so a way to get out of this is a refinance of this property, especially that they're coming up to renewal. There's not going to be a penalty to break their existing mortgage, although that is obviously a scenario. And so they came to me and said, what can we do? So I suggested that we do a refinance. So starting off, we extend the amortization out to 30 years. Now you are taking on more interest charge over time by extending, but you are giving yourself access to the lowest monthly payment. And right now, folks are struggling, and giving access to the lowest monthly payment can help monthly cash flows. Just keep in mind that if you wanted to stay on a similar amortization, all you have to do is figure out the amount that you have to prepay the mortgage to stay on that 20 years. The refinance rate that I set up for them was 4.14%. Property value stays the same at $500,000. We are accessing equity though. And so in this case, we are bumping their mortgage amount up to $352,000, just over that, to give them enough money to cover off these debts as well as cover the costs of the refinances. Getting into that right now, we do have the original mortgage, or the mortgage that we're taking on right now. We have to pay off the old mortgage that the client has. We have the debts that are to be covered off, an appraisal fee of $500, legal fees. If there is a penalty to break the client's mortgage, we can factor that into the calculator and even add it to this amount to make sure there's no cash out of pocket. So once we factored all of this in, the client's new monthly payment is $1,705, almost exactly what they were going to be facing with that new lender. The massive difference here is we are paying off all of the client's debt. MasterCard, line of credit, Visa, car loan have all been zeroed out. So their household monthly payment is $1,705. And because we've shaved off all of that credit payment, they have a cash flow improvement of over $2,000 per month. This is money that can be pushed back towards paying the mortgage down, bringing these debt levels back to where they were. This is emergency fund money, or this is just money where someone maybe doesn't have to work a part-time job to make ends meet. So a massive difference for these clients by doing this refinance and clearing off all of this consumer debt. Let's talk about the reality of refinancing to pay off debt. The number one pro is lower interest. Mortgages are some of the cheapest borrowing available. Shifting debt from 20% to 5% just makes mathematical sense. Pro number two, simplicity. One monthly payment instead of 5 or 6 different ones. It's easier to budget, easier to track. And pro number three, immediate cash flow relief. If you're juggling high payments, refinancing can free up money fast, and that breathing room can make all the difference. But there are risks. Risk number one, you are extending the timeline. That debt is now part of your mortgage. Even though the interest is lower, you are spreading it over a longer period, which can mean paying more total interest if you're not aggressive about repayment. Risk number two is you need discipline. Once those credit cards are paid off, they have to stay that way. The last thing you want to do is rack up more debt on top of your refinance. And risk number three, you're using your home as collateral. Now, that's not meant to sound scary, but it is a responsibility. You are securing now more debt against your property, so it's important to have a plan and to stick to it. And if you add too much debt and you can't handle the mortgage payment, you do risk losing the home if you are not able to make those payments. So that's how refinancing to pay off debt works. It's not about escaping debt overnight, but about taking control and putting your money to work more efficiently. If you like advanced mortgage strategies that help you pay your mortgage off faster, check out this video right here.